as the euphoria of the release of 2021 audited financials fizzle out, analysts say they expect a weak equities markets performance as investors await dividend payouts and the release of first quarter earnings next month. Gbolahan Ologunro, research analyst at Cordros Securities, joins me for a look at the stock market here in Nigeria. Thank you so much, Gbolahan, for joining us today. It looks like the market is losing some momentum, but then, of course, the investors are still eyeing dividend payouts. What can you tell us in terms of what investors' expectations are on those stocks that are on investors' radar?
Yeah, so thank you. Good afternoon. Thank you for having me. So like you rightly mentioned, the momentum in the market seems to have slowed down due to the winding down of 2021 full year earnings season. So most companies across sectors, particularly the heavyweights, the Dangote Cement, GTCO and Zenith in the banking space, Nestle in the consumer goods space, MTN and Airtel Africa in the telecommunication space. All these companies have published earnings, and a couple of them have also been marked down for dividends. So what you are seeing in the market is, a case of investors now unwinding the exposure to the equities market, given that dividend expectations has already materialized. So it's more a case of these stocks are now trading at ex-div prices. So investors are now taking advantage of book profit. Looking ahead into Q1 2021 earnings, we think in the banking space, investors would have their eyes on GTCO. If you recall last year, GTCO had very weak earnings, so investors will be looking forward to a rebound in earnings this year in order to re-rate that stock, given that we've seen a closure in the gap between GTCO and Zenith Bank share prices. So investors would want to see how earnings from GTCO will evolve in 2022, and of course that would probably give rise to re-rating from current levels.
Now, from your analysis, what is to be said about what do you see in terms of the dividend yield on key sectors or key stocks, particularly in the banking sector?
Yeah, so for now, with the markdown in the share prices of heavyweight stocks, particularly in banking space, GTCO and Zenith, dividend yields for 2022 are currently at around 14% levels, which is quite attractive. However, I think for us, we think the concern for investors now is expectations on development in the fixed income markets as we head into the second quarter of this year. So expectations are that yields will inch up in the fixed income markets as the federal government supplies more domestic debt instruments in order to bridge the fiscal deficit in the budget. So that would likely give rise to investors rotating or moving out funds from the equities market to the fixed income market. So that's why currently we are not seeing that positive reaction to attractive dividend yields on stocks with even sound fundamentals.
Now, it looks like Q1 could be a difficult one for companies, especially the mid-range companies. When one thinks about that from a cost perspective, power, especially we all know how cost of diesel has risen, and of course that has fizzled out or cascaded into some other items. So are investors cognizant of this factor that this may potentially affect the numbers?
Yes, certainly. We think that is also another burning issue for investors. For Q1 numbers, if you look at, the challenges we faced in the quarter, in the month of February, there were challenges with, the price of, challenges with, sourcing for PMS products in the market, in addition to surge in the price of diesel. So for companies that rely heavily on alternative source of power through generators, either powered by petrol or diesel, certainly you would expect to see the impact in terms of increased cost pressures. And don't forget that prior to that, we already have high level of inflation in the economy. So it's more like a double whammy from a cost perspective for companies across board. But for us, we think companies in the consumer goods space, particularly when you consider the surge in prices of, essential raw materials in the global market. Commodities like wheat, grains have increased significantly on the back of the tensions between Russia and Ukraine. So that would also be, a concern for investors from the perspective of compression in margins for companies in the consumer goods space. However, we also believe that, for companies in the banking and even the telco space, surge in price of diesel also puts some downward pressure on, profitability.
Now, for the oil and gas, we all also know, I mean, what's been happening, particularly in the Niger Delta, the oil theft, massive, oil theft going on. Is that impacting investors' sentiments towards the oil and gas sector downstream at the market?
Yeah, so for companies in the downstream sector, interestingly, we have not seen any sort of negative reaction from investors. I mean, the price of Total and Alova have been pretty much stable at current levels. So we think for investors, it's more like a trade-off, I mean, between whether these industry players benefited more from the increase in prices of, I mean, PMS products that were sold in the month of February and that's why in the month of March. I mean, recall that I mentioned due to, I mean, low supply of PMS products into the market, some of these industry players were able to hike prices significantly. So the question is, will that increment in prices make up for the shortfall in, I mean, volumes due to, I mean, reduced supply from NNPC? So we think, I mean, investors are pretty much just waiting for earnings from these industry players before reacting. But for the player in the upstream space, I mean, we've seen significant rally in the share price of Seplat on the back of uptick in oil prices and, I mean, the deal regarding the acquisition of MNPO assets. But because of, I mean, the recent action from NNPC regarding the rights of refusal, that has sort of created uncertainty regarding that, whether it will eventually go through. So for now, I mean, investors are still trying to get clarity on whether Seplat will eventually be able to win that case. I mean, when it eventually gets to the court.
Now, with all of these headwinds, and of course the forthcoming, cycle into elections next year, what are you telling your clients in terms of how they should balance their portfolios, what stocks to go with, etc.? How are you giving them some comfort?
Yeah, so for now, I mean, our view is that, I mean, you might begin to start unwinding some of your exposure in the equities markets and allow yields to, I mean, inch up in the fixed income markets. And even at current levels, you still see, I mean, upside. We still see scope for stocks with, I mean, yields at around 14% levels to inch higher to about 15% levels. So our recommendation now is, I mean, reduce exposure to equities in order to allow, I mean, yields to increase higher on those stocks. Notwithstanding, we still believe that, I mean, with companies in the consumer goods space that have, I mean, products with inelastic demand, that enables those companies to pass on, I mean, cost pressures in the economy to the consumers in form of higher prices. I mean, looking at names like flour mills, I mean, Dangote Sugar. So we believe that, I mean, these companies from a resilient, I mean, perspective in terms of them being able to weather the storm and challenges in the economy. Certainly, I mean, these are still decent names that investors can pitch their tent in despite the broad challenges in the economy.